As Thomas Lee has so eloquently stated throughout this year, this is one of the most hated V-shaped recoveries the equity markets have ever seen. Turmoil, according to the media, virtually everywhere you turn. Pick your poison: the Iran conflict, the Ukraine-Russia conflict, Maduro in Venezuela, Greenland, tariffs. Should I stop now? In the end, this is classic media doing everything in their power to keep everyone on edge continuously. This week, it is the drum roll up to the meeting between President Trump and China's Xi. As a result, the recovery in many indicators using the S&P 500 index as the universe for analysis should clearly be surprising, considering the index soared 10.4% in April, its best month since November 2020 and the second best April in the last 90 years. Calling upon statistics after the S&P 500 has gained at least 5% in April. Over the final 8 months of the year, the index has risen 86% of the time by a median of 19.0%. Since 1950, the S&P 500 has risen 8 out of 10 times by a median of 14.1%. The median drawdown has been 7.3%, and it has tended to start in late July and early August and end in mid to late September. The worst case was in 2001, in the aftermath of the dot-com bubble. The other was in 1978, the only other midterm year in the study. Here is the chart courtesy of Ned Davis Research. Harkening back to the dot-com days is the fact that the S&P 500 is hitting new highs while less than 60% of its constituents are above the 50 and 200-day moving averages. According to Bespoke Investment Group, that has only happened a handful of times since 1990, and you guessed it, those all occurred during the 1998 to 2000 tech bubble period. Again, that doesn't mean we are guaranteed a repeat of that legendary boom and bust cycle. And even if we are, it could mean we're in 1998 rather than 2000. Ordinarily, though, the current percentage of stocks above the 50 and 200-day moving average is more consistent with an S&P 500 down at least 4% from its highs, not hitting historical extremes. The worst total drawdown from a high at any point since the S&P 500 gapped higher on April 8th has only been 1.41%. To put that into perspective, going back to the start of last year, there have been 25 single sessions that have closed down more than that. Only 8 down days have occurred since March 30th, and the average loss in those sessions was a minuscule minus 0.25%. With almost 90% of the S&P 500 having now reported earnings, though, the day-to-day catalysts in individual names might be going away soon. The market may not care, but it is something to keep in mind. As for any short-term call, the line of least resistance remains higher. Until that changes, stocks can obviously keep going up. So the whole sell in May and go away concept seems to be a fear that many still seem to be holding on to. The reason being that March was so negative that the stage seemed to be aptly set for the sell in May during a midterm year decline to be in the offing. To take a very close look at this year, overlaid on the historical midterm year, going back to 1928, this is what we are currently doing versus what is normally the case. As I think nervously about how well the markets are doing and how negative the financial press is, I keep going back to the economy and corporate earnings. The prospect for slower economic growth, especially outside the U.S., has reinforced the multi-year theme of AI-driven U.S. growth stock leadership. When economic growth has been decelerating, growth stocks have tended to outperform value stocks. AI-driven capex accounted for nearly 2/3 of GDP growth in the first quarter. Economic growth is likely to moderate throughout 2026 as the sugar rush from AI fades and the impact of higher oil prices ripples through the economy. So AI investment could account for an even higher percentage moving forward. Looking at earnings are beating by a staggering 19%. This is like 2 years of earnings growth. It is like an emerging market situation, yet it is the most developed economy of the world. This is probably the official effect of AI. Here is the table. Now I want to address a couple of more points concerning the markets in general and exactly what is making them move as they are. By this I mean which sectors are performing and which are detracting from the performance. This should create a clear visual on what to pay attention to for possible turns in direction. To address the market, the S&P 500 from a general perspective, given the abrupt moves off the lows during the tariff tantrum in 2025 and the Iran conflict of 2026. This is what the technicians are forecasting. Notice that in this very small slice of time, the markets seem to be acting very similarly, even though the reason for the pullbacks are entirely different. This advance is being tentatively measured as an advance that should take some level of a rest around the 19th of May. This does not imply a decline, but rather a possible sideways move to catch its breath. Is there a catalyst for this? Not really, just based on the similarity of a move, this could be a consideration. This is not my opinion, but rather some yardsticks from super technical guys. And one of the most amazing readings that I am seeing is that of consumer sentiment. It is literally the lowest it has ever been in statistical history. Economy raging, earnings beating handily, and employment full, and sentiment the worst ever, as shown here. Next, I want to share the broad S&P 500 as the world follows it compared to the equal-weighted S&P. The equal-weighted holds the same names, but with the same voting power of each of the 500 versus the normal or capitalization-weighted S&P that is followed in the financial press. Please see here. First, the capitalization-weighted, followed by the equal-weighted. Note the strong uptrend by the cap-weighted, whereas the equal is having a very difficult time moving to higher highs. The logical question is why? What is it that is making one look so strong and the other so tired? To answer this, one needs to look at the components. It can be noticed that if one is to look at the upper right side of these two, that the first one broke out very strongly, where the lower one has not been able to better its February and March peak. This brings me to one of my most important tenets in investing. When exhaustion points are hit and the broad market reverses either from a high point down or a low point up, the move will show leadership in different sectors. In the case where the market comes up from a low point, as was the case in the beginning of April, it is important to recognize where leadership came from. To do this, I look at the collection of all sectors, of which there are 11 broad sectors. In looking at the 12 charts here, the one on the upper left is the S&P 500. I have noted with a yellow highlight the virtually straight up move from the March low. Then I have input a yellow highlight on the others that show the internal trend. It should be noticed that technology and real estate are really the only ones that have broken to new highs to any consequence. I have put a box around these two so they can be easily recognized and compared. In closing, it is clear that the markets have been very strong even though sentiment is poor, and there is a very contentious conflict still alive in the Middle East. At the same time, it is our responsibility to separate the wheat from the chaff and manage portfolios based on earnings and market analysis. Currently, the uptrend is still in full force. There are some sectors that are having a dreadful time of it, and others that are still in a very aggressive advance. Will this run out of gas? I'm sure it will at some point, but at present, interest rates, the US dollar, and overall commodity prices remain firm and in a consistent direction. When this changes, we will consider changes. Until then, as the saying goes, the trend is your friend until the trend ends. As always, please contact us if we may be of assistance.